Thanks, everybody. I'd like to thank Melissa and the panel before. I think that was quite educational in the different views on how, and it was a bit of an eye-opener for me on generational wealth. And I think some very good points were made that you just don't actually think about all the implications of generational wealth, divorce, different cultures and that. And I think that is quite telling. I really think that was a bit of an eye-opener and a bit of a lesson to me. For our next panel, we will be talking about ETFs, its current state and where it's going. For that, I've got two very esteemed panelists. My first one is Nerina Visser. She is a director and strategist at etfSA. She is also a financial advisor, and I think if you don't know Nerina by now, you're not involved in the financial markets in South Africa. So thank you very much, Nerina. Then also my second panelist is Deborah Fuhr. She is the founder and managing director of ETFGI. She has got a long history in ETFs, and I want to say it's probably one of the most respected people in the ETF market globally. So, Deborah, thank you very much for joining us. Deborah's joined us via Teams. She's busy. She's in high demand, so we really appreciate your time and that. Morning, Deborah. Can you hear us?
Yes, good morning. It's great to be joining you. I wish I was there in person, but glad to be there virtually.
I think for our next, as I said, for our next topic, we are going to talk about ETFs. I know it's very often in the media, and everybody's got a lot to say, and the great debate about passive and active management, but that's not what we're going to talk about here today. With my two panelists, I'm going to pose a couple of questions to them, and for first of those is I think it's probably a very good point to kick off, to ask first Deborah and then Nerina of where do we find ourselves in the ETF market? What is currently happening in the international market first? If Deborah can please expand to us what you're seeing, what's happening in Europe as well as in America, where we know those are the two largest markets currently.
Yeah, so maybe just to add a little perspective. So I've been doing research on the ETF industry for just over 25 years. So when I started, there were 21 ETFs and $8 billion invested in them. Today, globally, there are now 11,164 products with nearly 23,000 listings. We have $9.88 trillion invested globally. There's 678 providers. They're listed on 81 exchanges in 63 countries. So when we think about the ETF industry, the first ETF was listed in Canada, and it's celebrating its 33rd birthday on March 9th. The US just celebrated in January the 30th anniversary, and Europe will celebrate the 23rd anniversary in April. So when I think about the ETF industry, one of the things that really made it appealing to me is it is the only democratic investment product out there. And by that, I mean, we see ETFs being used by pension funds, asset managers, hedge funds, insurance companies, and also financial advisors, and then retail. And they use the exact same products with the same small minimum investment size and a very cost-efficient annual cost. And that has allowed investors to really think about asset allocation and savings in a way that wasn't available to them before the ETF, because usually retail would have a small toolbox and high fees, and institutions would have a big toolbox and low fees. So when I think about what's going on, what we are seeing is that during COVID, many people, because they were forced to stay at home, started to look at their finances and how to save. And many went to robos and became informed about how to think about saving. And most robos have ETFs inside of them. So they learned the benefit of asset allocation. They learned the benefit of over the long run investing in lower cost products gives you better returns. And they also learned about ETFs in general. And what we also saw was during the COVID period, there were many new investors entering the market. So in the US, there were 15% of investors trading in the market in 2021 were new. There were 1 million new investors in Canada. It's hard to get data in every other jurisdiction because I don't think people ask, but I would say people sitting at home did look at investing. And I think that many learned that ETFs are a useful tool. We've had 44 months of consecutive net inflows. And so, an ETF is, in essence, a mutual fund with the added benefit of being listed and traded on exchanges. And so that means you can get in or out whenever you want to. You can get exposure to equity, fixed income, and commodities. And, we do now also have active ETFs, and I know Nerina is going to speak about some of the evolution happening in South Africa specifically, but, it's just another way to get exposure, and I think it adds a lot of benefit. So people are using them to one-off, get exposure to a theme, get exposure to international markets. There's many ways they're being used, and I think the interesting thing is, although we're celebrating 33 years, in many ways, ETFs are still acting like a child where people are discovering them for the first time and discovering new ways to use them. And so I would say the challenge for most people is until they try, they're not really sure about ETFs. But once they try, they use ETFs in more ways and in larger sizes. So it's really getting people to make that first attempt to use them in some way that you find they really do become a tool to help you do your job.
Sure, that's a lot of information, but what always catches me is the astounding growth, and just correct me, was it 44 months of net positive flows? That is
correct.
I think that's something to say. Nerina, your side, what are we seeing in the local market happening?
It is most definitely an industry of evolution, and I think I can almost define the evolution of exchange-traded products through 4 phases. The very first phase Deborah referred to, when the first one was listed in Canada, in the US, even in South Africa, where our first ETF was listed in the year 2000, so celebrating its 23rd birthday this year. That very first evolution of this was all about vanilla basic index tracking, broad-based market access. Your top 40, your FTSE 100, your S&P 500, very simple, easy to understand access to a basket of broadly diversified equities. The second evolution was really to say, but that same principle of broad-based asset class exposure can also be applied to other asset classes. So we saw the evolution going from equities only to bonds, to listed property, even to commodities. So the access to different asset classes suddenly started to open up the opportunity for multi-asset portfolios, asset allocation decisions being implemented using ETFs. The third evolution for me really was all about moving away from traditional, what I would almost call vanilla indexation, which is market cap weighted, because there's a lot of valid criticism around the fallacy of market cap weighted indices. And I think especially in South Africa, we're very, very aware of the problems associated with almost pure, blind, unintelligent market cap weighting, whereas we know that the drivers of performance in investments go much beyond size. So we saw the rise in the introduction of so-called smart beta or factor beta or strategy beta. So this is where you were looking at factors such as maybe dividend strategies or momentum or value or any number of these, and really sort of moving away from the idea of only using size or market cap as the basis for your indexation. But we are currently in the fourth wave, the fourth evolution in terms of this, and this is about the introduction of actively managed strategies inside exchange-traded funds, inside exchange-traded products. And it's a very exciting phase, and it's really sort of starting to blur this line between what was in ancient times, I'm going to say, known as the active versus passive. You realize now that actually it's become one big blurry area. But there's one golden thread that runs throughout this entire evolution of exchange-traded products, and it sits in that ET bit of the name, exchange-traded. It's about the access point. It's about where do I actually buy these investments. Most of you and most of our industry operates on the basis of what is effectively OTC product, over the counter. If you are investing in unit trusts or you are investing into pension fund investments, those are OTC. Whereas an exchange-traded product brings that exact same product to a listing on the stock exchange, which brings with it a whole host of additional benefits, especially to the client, but certainly also to the whole administrative process. So we really once and for all need to break this link between thinking that when we hear ETF, we're just talking about a boring old top 40 or S&P 500 index. This is about an access point, and I love the point that Deborah raised in terms of the democratization. The fact that this really is an investment instrument that allows equal treatment of any and every and all investors. And the simple reason for that is that you cannot have multiple fee classes in an exchange-traded product, because it trades right throughout the trading day at one price for everybody that trades at that time. So you can't accommodate multiple fee classes. And that's really where the democratization comes in. And I think in a country like South Africa, we're so aware of how important this is to really open up financial inclusion and to give access to investment opportunities for all and any investors. And probably one of the main reasons why I'm so passionate about the instrument, the exchange-traded product instrument. What the underlying is, how we manage it, whether it's active or not, whether it's a bond, whether it's a commodity, those are details. I want us to understand that as long as we are also managing our client assets through traditional LISP platforms that don't provide ready access to exchange-traded products, we are necessarily excluded from a massive opportunity set in terms of how we can better service our clients. And I'm going to leave it at that.
Yeah, thank you. I think for me, there's one comment and one thought. And the one comment is both my colleagues here, is everybody is equal in ETFs. Mm-hmm. i.e. there's no institutions, individuals, no one gets better or worse pricing. Everybody gets the same pricing. And I think that's one of the really big draw cards. And at 1nvest, we see it as well. We've got what I call do-it-yourself investors. They log on to online broker platforms. They want to play around and do their own investing. They do it through TFSI accounts. Then we've got a lot of IFAs, advisors like yourself, helping their clients manage their portfolios. And for that, they take that advice fee. And I think, and a previous panel touched on this, people still want to talk to people and because financial decisions are important. They will play around, get information, but before they push that button, they want to talk to someone, and that's a comfort, and they're willing to pay for it. Then we also have DFMs as well as large institutional investors in our ETFs. And that's also the multi-use in an ETF. It's not just a long-only investment. And here's the comment of mine. Everybody says, yeah, ETFs aren't buy and hold, traditional. Yes, you can do that. They're long-term investment. But there are also strategic trading instruments, allocation asset instruments. And there's a financial advisor is a key role in that to help your clients move between geographies, asset classes, and that. So it's not just buying an ETF, putting it in the back pocket and forgetting about it. It's actively managing that ETF portfolio that is key. So, Deborah, in South Africa, there's our index tracking or industry is going quite quickly. Similar, we're seeing this total J curve at this stage. In South Africa, there's quite a hot debate between unit trust, index tracking unit trusts, or internationally it will be mutual funds, and ETFs. Please, what is happening internationally, and are you also seeing a divergence there, or is most of this going into the ETFs? Where is it going?
You know, that's a great question. And what we are seeing is many investors are preferring ETFs over mutual funds. So if you look at mutual funds in terms of consistent consecutive net inflows, you definitely do not see 44 months of consecutive net inflows. There's been many months where mutual funds have suffered outflows. What we're seeing in the US, which I think really resonates globally, is that most asset managers who have products are seeing demand from their end clients to convert or launch ETFs. And so a trend that started about 2 years ago in the US is that many of the large asset managers are converting existing mutual funds into ETFs. So we've seen Dimensional Fund Advisors, Capital Group, T. Rowe Price, Putnam. I mean, the list is pretty long. There's like 20 firms. So I think today, when you look at asset managers, they're all thinking ETFs are just another wrapper that they want to and should be able to offer to their clients. So I really believe it's just a question of time when we see really all of the large asset managers have an ETF offering. I mean, recently, actually, Morgan Stanley just entered the ETF industry, someplace I worked for 11 years. We had expected to launch ETFs back in 2000. I think if we had back then, we probably would have been the biggest asset manager in Europe for ETFs, but it's kind of water under the bridge at this point. So I do think that ETFs are really growing. And as Nerina said, right now, it's not a debate about active or passive. And I would say many people think about ETFs, if they are tracking indexes, index products. And most investors are approaching things in a barbell approach. So where they can find alpha, they do it, whether it's security selection, ETFs that are active, or mutual funds. But where they can't, they often use index products to generate alpha through asset allocation. So overweighting countries, underweighting countries, sectors, or changing asset classes. And as you said, sometimes that's tactical and sometimes it is longer term. So I do believe that ETFs really are in a significant phase of that upward slope, because we are seeing many asset managers finally embrace them after they've been out there for 33 years.
Yeah, thank you, Deborah. It's interesting. Nerina, what are we seeing in the local markets here?
So some of those similar trends that Deborah has been referring to, but I think there's one distinct difference in terms of what we see in South Africa and should expect to see that is not going to replicate what's happening in the US. For starters, one of the main reasons why the ETF industry, in particular in the US, has been so successful is that it actually offers tax advantages that the mutual fund in the US does not offer. In South Africa, our unit trusts and our CIS ETFs have got exactly the same tax advantages. So there's not that same underlying drive to actually get into ETFs rather than mutual funds or unit trusts, because we don't have separate or better tax advantages. The other very important aspect is that we do now have the introduction of actively managed ETFs on the JSE, but the FSCA has specifically said that we cannot convert existing unit trusts into ETFs. Now, that's a trend that we saw very strongly taking root in the US. We're not going to see that in South Africa. The FSCA is still going to require that it will be a separate physical fund or portfolio that underlies an ETF. So even if you've got exactly the same strategy in your unit trust that you now want to list as an ETF, it's going to have to be two separate funds, which I think is unfortunate, because I think it's necessarily going to inhibit the extent of the conversion into ETFs. But what we definitely have, and I want you to think, if we now focus on the exchange-traded product category of this, is that we're now starting to see a clear, almost matrix in terms of different options. The first differentiation sits behind what the underlying asset type is. Is it a physically backed fund, which belongs to the investors, or is it a bank-issued note or a credit instrument? What I mean with that is a CIS or an ETF, an exchange-traded fund. The underlying is a CIS, or it's a ring-fenced asset that belongs to the investor. So that's sort of one aspect of it. The other one where we've seen significant growth in recent times is in what was just first exchange-traded notes. So these are bank-issued instruments, and the majority of these were also index tracking products. But we now also have in the second dimension, so if you think fund versus note, in the other dimension, you've then got index tracking versus actively managed. And so you've got both of those in both product types. We've seen a very strong rise in so-called actively managed certificates. That's been the first wave of active actively managed exchange traded products that we've got in South Africa. And Standard Bank themselves are one of the big issuers of these actively managed certificates. But we also have the listing requirements in place now for actively managed ETFs. So we should expect a rise in terms of, think of this as the quadrant of 4 different product types. So what's quite important is that you see asset managers coming more and more to the table saying, I'm agnostic as far as the wrapper type is concerned. I don't really care whether you invest in my fund using a unit trust or an ETF or a note or a managed certificate or whatever. I need to be able to offer multiple wrapper types in order to access a broader investor range. And very interesting for me in this space is especially your mid-sized boutique asset managers who are very interested in the actively managed ETF space because they see a whole new distribution channel of access to client money and to investors via the listed entity, via the personal stockbroker model. So as an IFA who primarily focuses on list platforms and unlisted investments, you are necessarily missing out on that client flow that comes through stockbrokers and through stockbroking portfolios. So I think there's a very interesting sort of level of evolution that is taking place in terms of this and around the product wrapper types in particular. Clearly there are advantages and disadvantages to all of these. So as an advisor also, it's going to be very important that you understand what the pros and the cons of each of those are, especially when it comes to things like the tax implications, the credit risk associated with a note versus a fund, for example. And I love the type of comments that was made in the previous panel around what are some of those important human aspects that you really need to understand well and to understand how that best matches your client in terms of their particular tax position or their liquidity requirements that they might have or whatever the case might be. The underlying product or investment strategy is just one question. Which wrapper and which conduit or access point I'm going to use is a separate decision all on its own.
Yeah, thanks, Nerina. And I think the one question there pertinent, and I think particularly for our audience, Deborah, what are the advisors internationally using, or how are they accessing these products currently?
Yeah, that's a great question. I think some of them are using ETFs kind of one-off. So often what they'll do, well, in South Africa, you have Nerina and her company helping you figure out what products are out there. So that's kind of a useful tool. But in general, the media is quite active in talking about ETFs in the US. So if you were to watch CNBC in the US, anytime they talk about what's happening, they're talking about ETFs with tickers for countries, for sectors, for themes. And so I think people see that, their clients listen to that, the advisors hear that. But what we are seeing as a major trend in the US and slowly coming to Europe is many of the advisors and banks and brokers and platforms are creating what we would call model portfolios. And so basically they're creating portfolios that could be balanced, they could be tactical asset allocation, sector rotation, even produced by some professors. And so you can invest in a portfolio that underlying it is a basket of ETFs. And so for many advisors, as the job of being an advisor becomes more challenging, your clients want you to be able to help them with tax, and they want you to know both the husband and wife are partners in the relationship and the children. You need to do a lot more. And so you're finding that many advisors will use a model portfolio to be able to manage the asset allocation for their clients. So I think model portfolios is a big trend. I think online platforms are becoming more important. We even saw here in the UK, Hargreaves have just launched 3 model portfolios the first time, and they're using a combination of mutual funds and ETFs. So as Nerina said, sometimes you might use mutual funds, sometimes you might use ETFs. So I think sometimes it's directly going and looking at ETFs as a one-off sleeve, a core, a satellite, tactical allocation. Other times it can be the entire portfolio.
Yeah, thanks, Deborah. Nerina, in our local market, what are we seeing? How are advisors accessing and using? And very much to Deborah's point as well, model portfolios, does it exist? What are we seeing happening locally?
Yes, there are some model portfolios, but I think it's in the infant stage. I think it's really relatively early days, but I would expect that to grow over time as well. What we are seeing a lot of is that because of the transparency of exchange-traded products and because of the consistency with which an index or a rules basis determines the underlying investments, it gives a very strong tool for an advisor to identify specific products that suits client objectives. So we're finding a lot of focus in terms of, I'm looking for a specific solution to my client's problem. That might be a completion strategy to actually get exposure to a specific region or to a specific industry globally. Or it might be about a specific income requirement that a client might have, or whatever your client objective is. It's often a lot easier to translate that into an exchange-traded product or a couple of exchange-traded products that actually solve for that client objective. We also see that in terms of indexation, index-based products, rules-based products, there's a much bigger range of strategies available in ETF or exchange-traded product form than they are in unit trust form. Your index tracking unit trusts are very vanilla, very bland, quite a lot of strong, big multi-asset portfolios, which I guess is to some extent almost a bit like a model portfolio. So there's a big space there. But other than that, there's very little differentiated strategies, index-based strategies in unit trust form. But when you go to the ETF space, I mean, we have over 180 exchange-traded products listed on the JSE. That's a lot more than the number of investable companies that you've got on the JSE. Yes, it's not quite there. I don't even know, I've lost track of the number of unit trusts we have in this country, but it's still not there. But the fact is that you've got a vast range of types of strategies. And so, for example, focusing on things like dividend-paying strategies, something which might be very important in your client requirements, or getting exposure to particular global markets or to regions. You know, a very strong theme prior to 2022 was thematic investments. And unfortunately, we found that a lot of the thematic investments also ended up being in a lot of your growth industries. So it was tech, it was about sort of biotechnology and healthcare and those sort of things, which certainly was not the flavor of the month in 2022. But the point is that you have the ability to actually access such very targeted exposures through a rules-based or an index-based product in an ETF, something which is extremely difficult to come by in the unit trust space.
No, thank you. And I think it reiterates my point, what you're trying to say. There is a responsibility to manage this portfolio.
Absolutely.
And yes, give the right advice, target it what you want, but manage this portfolio. Deborah, any final thoughts on that before we finish off?
I guess, having been in the industry for a long time, if you're afraid to do ETFs and you're afraid to ask questions, never assume. There's never a bad question. I think there's a lot of us who've been involved in the industry, and Nerina is one of the people who I would say is always willing and able to help. So if you're not sure, just ask. Johann also has been involved with the industry for a long time. So we always want to see people understand what they're doing and do it properly. And I think asking the questions is the best advice we can probably share with anyone.
Thank you very much. Nerina, final thoughts?
I think as an advisor, it's incredibly important to upskill yourself in this space and to understand what should be the basis for selecting a particular index-based product or an ETF, or even for that matter then an actively managed certificate, and I guess even for selecting a specific unit trust for your client. The skill set that is required in order to do this is something that might not come naturally to you. The way that you assessed investment opportunities in the past might be quite different in the index-based world. So I really encourage you, and yes, absolutely, educate yourself. It's one of the great things about these products is that they are so transparent. Please don't look at past performance. Not because past performance has been bad, but because it really is no indication of future performance. I want to encourage you to look at the investment objective, the index objective. How is that index constructed? What is the starting universe? What is the selection criteria? What is the basis on which it is then weighted or added into the portfolio? Those are really the key indicators that's going to give you some sort of idea of what performance I should expect derived in future from this, and how to best match that back to my client investment objectives. It's a great opportunity as an advisor, I think, to really sort of prove your value by being able to match client needs and client outcome requirements to specific targeted investment exposures that actually solve the client needs. So.
No, thank you very much. And I think there's a lot of valuable information that was shared here. And the one comment that just sprung to mind while you were talking, Nerina, is the one question that always comes up on the ETF and say, yeah, but it's small or it's not liquid in that. By all means, an ETF takes its liquidity from the sum of its underlying components, because that's what you're buying at the end of the day.
Yep.
Instead of you having to go and pick those underlying components, let's use a top 40. I think to buy the top 40, you currently need about, 500, 600,000 Rand and then you can buy the top 40 and its constitutes for a client, or you can buy a top 40 ETF where all of that. But that top 40 ETF, while it doesn't seem that way, is as liquid as the underlying top 40. So that's the one passing thought for me. Before I thank my colleagues, I don't know if I'm going to ask if there's any immediate questions for either Deborah or Nerina.
I just want to find out about tax efficiency when you select the ETFs from the platform, especially when you select them from the, not direct, but from the unit trust platform, like STANLIB platform. You go there and select one of the ETFs. Are there any tax efficiency to that?
So the tax issues sit really inside the product. So if your ETF is also a CIS, a unit trust, then there's absolutely no difference in terms of the tax implications inside the ETF. Similarly, the tax implications of buying the instrument, selling the instrument would be exactly the same as it is with the CIS. There would be potentially capital gains tax implications on selling the product. But if there are any changes inside the ETF, no tax implications because it's in a CIS vehicle, so it enjoys exactly the same legislative protection that your unit trust has as well. When it's an exchange-traded note or an actively managed certificate, there could be specific tax implications in terms of that. There you are buying a security, an instrument. So I think the tax implications of those types of instruments depends a lot more on the specific investor type also. But a pure vanilla CIS-backed ETF, no different from a tax perspective than an ordinary unlisted unit trust.
Yep. Thank you. I think my time has come, unfortunately. I think we can talk a lot. Thank you, Deborah. I really appreciate it. I know it's early morning in the US. I really appreciate your time to come and share your vast knowledge with us here. Nerina, thank you very much. It's always inspirational to listen to you. Up next, my colleague, Wehmeyer. He's going to chat a bit about the regulatory stances and how that works, which we all have to pay a lot of attention to, otherwise none of us have got jobs. But yeah, thank you very much. Afterwards, please speak to the 1nvest people if you've got any more questions, or Nerina. Thank you very much. Appreciate it.
Thanks, everybody.
Morning, everybody. I see my panelists are coming on. First on the stage is Adele Hattingh. She joins us from the JSE. She's part of the primary markets team looking at the business development for exchange-traded products, essentially. And then my colleague from STANLIB, Karabo, who heads up investment compliance at STANLIB. Let's take a seat and maybe have a more comfortable conversation. I don't think we're going to go the route that Johann sketched out, where you have to listen because you're afraid of what's going to happen. We're more going to have a conversation around what's possible in the South African market, what are the new developments that are going to keep you abreast in order to have an informed conversation with your client. And I think the previous session teed it up quite nicely. They touched on actively managed certificates, actively managed ETFs. We're going to chat a bit about how the index landscape in South Africa has changed from a JSE perspective specifically, and then I'm going to jump into a couple of quick industry topics that are quite hot at the moment, and I'm going to ask Karabo for his opinion on that. So my panelists, we had a bit of a briefing session, and we spoke about questions. So you're only going to get half of those questions. The other 50% is going to be off the bat, so hopefully you're ready for them. But let's keep this interactive. After each small session, I'm going to stop and see if there's a quick hand raise, and then we can move on to the next one. So before we kick off with actively managed ETFs and the regulatory framework around that, maybe Adele and Karabo, from both your perspectives, just give a quick overview of the the landscape as it sits with the JSE and Karabo, as you see with the broader regulatory landscape with the FSCA. And then we can jump into the first session.
As it pertains to ETFs or ETPs?
Yeah, or in general, like what's at the JSE's core, because we've heard a lot of things around liquidity is dwindling. We've seen increase in listings, but maybe liquidity is not, like what's keeping the JSE awake, and what are you seeing for the financial market in South Africa?
So I think definitely very topical is that investors are looking for choice. I think
I just can't see my other panelists, so I just need to make eye contact with them.
And I think that's been an ongoing battle for many big asset managers specifically. Choosing the pool has become smaller. In their view, liquidity access has become limited. And I think the JSE has now really become a lot more focused in introducing choice to investors, and that is in the form of specialist securities. ETFs, ETNs, AMCs, actively managed certificates, and how we are branching out in those respective product types especially. So I think the JSE is really trying to establish itself as not just a traditional stock exchange, we are a securities market, and in that as well, we are now also branching into the private market, believe it or not. So we actually have a private placements part of our business as well, really trying to offer the one-stop shop essentially to our investors, not just locally, but globally as well.
In short, I think the FSCA generally is looking at how to bolster the conduct framework throughout. So that conduct framework split into multiple aspects. So aspect of integrating the general TCF requirements into general legislation. However, we're not seeing that coming through anytime soon. We're expecting that to come through as a result of the Conduct of Financial Institutions Act, which is COFI. But we're also starting to see, particularly in 2023 and again in 2024, a bit of shift from an investment-related legislation that the FSCA is working towards, and that's across multiple regulators or regulations. Whether it is in the pension fund space, we saw the introduction of the revised Reg 28 come into effect on the 3rd of January. They've also published conditions for derivatives inclusion in retirement funds, and largely aligned to what you would ordinarily see from a CIS space. On the CIS space, we expected that there would be new legislation around product disclosures. That has been put on the back burner, and for obvious reasons. I guess I'll preempt you now, is that if you look at what is currently happening, there's a unique case in the SA market around regulatory arbitrage, where you expect regulatory arbitrage to be between one jurisdiction relative to another. Here we've got regulatory arbitrage between one piece of legislation relative to the other piece of legislation around disclosure. So if you look at disclosure as a topic in itself, so if you, from a FACE perspective, there's general code of conducts for FACE that touches a little bit on disclosures around performance, around the do's and don'ts, illustrative marketing and so forth. And you've got a well-established, well-oiled machine within the CIS space, which is Board Notice 92, that is more descriptive in terms of what the do's and don'ts when it comes to disclosures. So where the regulatory arbitrage comes into place is that when you look at model portfolios, our previous colleagues were speaking about model portfolios just now, is that in a model portfolio, you set up a model portfolio today, but in your fact sheet, you've got performance for the past 10 years, you know. Would that apply in the normal CIS space? I can tell you that's not going to apply, because previous cases has shown that the regulator has clamped down on cases like that. But it's at the strength of the regulatory regime that exists. That's why we're seeing that from a disclosure marketing perspective, that piece of legislation going into the future is going to be harmonized, because by now we would have expected the CIS space to have revised the marketing and disclosures element and they took a backseat on it so that that harmonization can come into place, which means then from a model portfolio perspective, from an advice perspective, we're going to start seeing those converge into one big piece of legislation where there's an equal playing field amongst everyone. Because again, if you set up shop in January, but you've got past performance for the past 10 years, what do you say about that performance? And how do you position that to your investors? And that's something that we expect to happen going into the future.
So Karabo, my takeaway there is the FSCA and general regulation in South Africa has become less restrictive. So we've seen an increase in the offshore limit, we've seen the introduction of more derivatives allowance, we've seen additional instruments. But if you want to do that, you need to increase disclosure and increase your regulation in order to ensure that the client that is on the other side is getting the right advice into the right product. So I think sometimes it feels like an additional burden from a compliance perspective or disclosure perspective, but it's actually there in order to play in this field that is a lot wider than it was 15, 20 years ago. So it should actually be encouraged because it does allow you to differentiate yourself by utilizing all the tools to your disposal. So I'm going to give you a bit of a rest, Karabo, then I'm going to jump to Adele. On actively managed ETFs, and we heard about it earlier, and it sometimes sounds like a bit of a, when I heard it for the first time, it's a bit of an oxymoron because I associated ETFs with index tracking and now you're bringing active to it. So the JSE's been on a journey around listing requirements for actively managed ETFs. You announced last year that it can happen. Maybe just give us a quick update on where you are, what is the regulatory framework, have you seen applications, can you or can't you say if you've seen applications, just nod once, and what is the JSE's projections on actively managed ETFs in the future?
So you want the crystal ball?
As clear as it can be. Yeah.
So maybe I would just, if I go back and just try and lay the land, how we came about with actively managed ETFs, it was really an answer to local demand and also what was happening locally, I mean globally rather. And Debbie was talking about the proliferation of active ETFs specifically. So the JSE, through quite a lot of consultation locally and having conversations with global experts as well in the active ETF space, have been able to design a set of requirements that could ultimately address some of the very topical concerns that are often associated with active management. And this is particularly for the issuer. So in the traditional space, the ETF, the passive ETF structure, we require that all the constituents of the ETF is disclosed on a daily basis. Disclosure, you're providing information to the investor to make an investment decision. He can see the bells and whistles. Now, within the active space, as you would probably all know, is there's a real drive to protect the intellectual property behind the active strategy. You don't want the risk of a competitor replicating what you ultimately offering your client, or even getting your client to replicate what you're trying to give them. And that was quite a big concern, especially in the US. So active ETFs are not a new thing. Actually, the first active ETF, I think, listed in 2008. And for a large degree, I think it just ticked over. And again, those requirements also stated that everything should be published. All the constituents, everything, the warts and all. And because of that, I think the active markets didn't really pick up traction as was hoped for. Then a big change happened in the US, where they ultimately allowed for, I want to say, delayed disclosure or almost non-transparent or semi-transparent versions of these ETFs. In that way, protecting the IP that an asset manager would particularly be very guarded over, but at the same time still providing the investor with information that he or she needed to make their investment decision. And once this change actually came into effect in about 2019, we saw a huge take-up in active ETFs. And those came out of semi-transparent and non-transparent, essentially where the constituents of the ETF are either disclosed less regularly, made monthly or quarterly, or there's even a non-transparent version where you actually have view of a proxy basket, not the actual underlying constituents, but what might potentially look like a proxy version of that fund. And to a large degree, the South African market took a similar approach. So we offer our issuers, our active ETF issuers, the opportunity to disclose everything, all the constituents, how the fund essentially is constructed. And there are issuers that are very amenable to that. They are willing to disclose everything. They have no qualms about protecting their IP as such. But we've also offered a second model to issuers, and it's probably very much more aligned to the unit trust world. And I mean that in terms of disclosure. What made this really, really tricky for JSE is because we are a public market, we have to make sure that there's information out there, that the investor is empowered with enough information, again, to make his investment decisions. But at the same time, we cannot allow that one participant or one group or individual or grouping of individuals should have more information than the rest of the market. Then you sit with an information asymmetry problem. And that then leads to all kinds of insider trading contraventions and all those hairy things that we wouldn't be able to have done. So in the second model, we've said, well, now you can disclose the holdings of this actively managed ETF on a quarterly basis with a 30-day lag, very much in line with what the unit trust industry is ultimately allowing. But in lieu of the fact that it's not as, I wouldn't say not as transparent, but differently transparent, we require that there is an indicative NAV, a net asset value that's published at least 3 times a day, that serves as a pulse of what the underlying value of the fund is actually worth, in essence. On top of that, we still require that there's a market maker that facilitates liquidity, but we are also very specific that whatever market the market maker is making has to be off the base of publicly available information. Again, that he does not have, or she does not have, an advantage over anyone else in the market as it pertains to proprietary information.
Karabo, so I view actively managed ETF as basically an active fund listed on the exchange in the simplicity. So if we think about Adele mentioning the issuer, is the issuer the same as the manco? And secondly, if we start thinking about utilization of active ETFs in traditional fund of funds, CISs, model portfolios, is the FSCA of the view from a limit perspective and what you can and can't do, is an actively managed ETF treated the same as an actively managed unit trust?
Yes to both.
Beautiful. I wanted to say we're going to go into like speed debating now, where you're going to get 30 seconds to a minute to answer your question, because we need to go through things.
Yes to both. The manco remains the issuer of ETFs. Active ETFs, same equal footing as normal ETFs and normal CISs. They are regarded as collective investment schemes, so 20% on a CIS and up to 70% in a fund of fund.
So in my mind, the only thing is changing, you're moving the shop. So you're moving the shop from the manco and the LISP to on exchange. And I see a couple of benefits, but also drawbacks to that from a development perspective. And I'm giving my 2 cents on the previous session here. I think the South African industry is heavily intermediated, and those intermediaries are normally plugged into LISPs or mancos for their operational setup. Run models on a single portfolio, on a single platform, get the reporting from a single platform. So I think if we can shift a seamless integration between exchange and LISP so that products can be bought side by side, then actively ETFs have got a way to go. And the second thing is, you don't differentiate in the product, you differentiate on where you buy. And the problem historically with LISP is they are, as much as you can buy, they're still gatekeepers. They've got a approved list, they've got a justification to bring your products, and I think Nerina mentioned around, especially smaller active funds. If you go on exchange, it's open architecture. Anybody can go and buy it. You don't need to ask somebody, please can you show my products to the clients? It's there. In terms of, let's move over to actively managed certificates. Again, it was mentioned earlier. What's the, Adele, from a regulatory perspective, what's the difference between an active managed certificate and an active managed ETF, given that both are listed on the exchange?
So in simple terms, the ETF is a fund, and the AMC is a note or debt instrument. So the formal definition of an actively managed certificate is it is a non-interest-bearing certificate issued by a bank that offers exposure to a portfolio that is discretionarily managed. So if you think of it, and we only allow banks to issue AMCs, and the reason for that is that there's a credit risk exposure to the note. So it's off the issuer's balance sheet. Now the bank would issue the note, and the note then ultimately promises the performance of an actively managed portfolio, not a CIS fund, a portfolio. And that is then managed by an independent investment manager with a Cat 2 license. What I think makes AMCs particularly interesting is that you're now able to list again an actively managed instrument on the exchange, but without the concerns around CISCA and all the limitations surrounding CISCA particularly. Because this portfolio that's managed by this investment manager is not bound by any limitations that you would find in CISCA, you also have scope for a lot of customizing of the portfolio. There are limitations from the JSE's perspective in that we do require that the underlying within the portfolio is still sufficiently liquid. You cannot just put anything in that portfolio. We do have limits as such. So listed securities on recognized exchanges, global exchanges, is permissible. Commodities, we also allow derivatives with a limit of 10%. And then we all have a very open-ended comment at the end, and any other assets acceptable to the JSE. So, I mean, that's the reg team's responsibility.
That's the loophole.
Yes. And I leave that problem to them, it's not my problem. But essentially, this flexibility allows for an investor now to have really interesting exposure to probably assets that they probably wouldn't have had access to, and probably a volume that they probably wouldn't have had they maybe gone the more not going to say more regulated, but the differently regulated route of a CIS. The other thing to consider with an AMC as well is the fact that the makeup of it and the construction of the AMC offers a great deal of efficiency. So ultimately, you're able to get an AMC up and running fairly quickly. You're not stuck with a whole lot of regulatory red tape that would typically be associated with establishing a CIS fund. So that's that benefit. I think that's really interesting. In particular, if you think for a portfolio manager, boutique asset manager, that's a Cat 2, he's now able to design, with the help of a bank, a solution for their client that is accessible on through a broker's platform, essentially trading platform. But the fact that it's really quick and easy to access, I think, is the real thing. Plus, you can now service multiple clients through a single AMC. You don't need to go and establish a single portfolios for all your individual clients. And I think that really takes the headache out of managing, a plethora of investors.
Great. Karabo, AMC versus active managed ETF within the CISCA framework. Fund of fund, normal CIS, model portfolios, maybe even Reg 28. What are the limits and what are the differences?
So, Reg 28, fine. Model portfolios, fine. Normal CIS, not fine. The FSCA in 2014 issued a guidance note around the usage of actively managed certificates and basically said that they are a means of circumventing provisions of CISCA. Hence, they were not allowing that in CIS funds. We did reach out to our trustees as well as the FSCA, and I think that position still stands. It might change with the rewrite of Board Notice 90, but we don't know.
And just while you were talking, so AMC is basically an actively managed note, and an ELN is like an index tracking note, essentially.
Yeah.
So, but ELNs are allowed in CIS.
They are allowed in the CIS, so because there's a specific provision in Board Notice 90 that allows for exchange trade equity-linked notes, that it needs to be fully funded, it needs to be issued by a bank, and it needs to be the underlying needs to be a recognized index. So that would be covered in the case of ELNs, but not so much because the underlying is actually a portfolio.
It's synthetic, yeah.
It's a synthetic portfolio, and that's what the regulator is frowning upon. Yeah.
Perfect. Adele, in a minute, index harmonization is an announcement JSE made last year, start of this year, around proposed index changes. Just quickly, what is it about and what's the objective or the outcome that you intend from a JSE perspective?
I think the bottom line is we're trying to remove duplication and we're trying to allow for consistent treatment of companies within the index. And what I mean by that is with this index harmonization is we are now looking at one broad-based market cap weighted methodology where all companies are treated consistently in terms of the free float calculation. This is getting very technical, I realize. And then the second thing is, as I mentioned, we're trying to reduce the number of indices that are similar looking, similar performing, well, not performing in terms of the construction, but that potentially have overlap. So as an example, what we're doing is we've got the vanilla index, and when I say vanilla, let's call it the capped all share index. And you've got the SWIX capped all share index. For all intents and purposes, it's the same thing. However, in the vanilla index, you've got a couple of companies, 4 actually, who are treated differently in terms of their free float exposure. And in the SWIX index, you've got the same companies, those 4 as well, that are, their free float is treated in terms of the straight registers free float calculation. What we are now doing, we're taking the vanilla index and the SWIX index, we are harmonizing it into one. We're saying we're keeping this one index, but we're only allowing for one index methodology, and that is the SWIX index methodology. We're not using the label SWIX anymore. We're saying we're using the methodology, but now essentially it's a vanilla index that looks like a vanilla index, but it's basically constructed using the SWIX methodology.
So essentially, 1nvest has got a top 40 ETF and we've got a SWIX 40 ETF. In the future, the underlying benchmarks are going to become the same thing, so we're going to amalgamate and have a single fund.
Yeah, but
so
using the SWIX methodology, yes.
Perfect. Karabo, I'm going to throw out one of the last questions, which I think is quite contentious, and it's been murmured in the market for multiple years, is around taxation within unit trusts. And that's always been not tax in the unit trust, it's only tax when you sell or buy the unit trust. So what's the latest on that? Is there something to report? If you read the tea leaves, what are you seeing for the future?
Yeah, I mean, towards the end of last year, ASISA brought us into a room to discuss possibilities if this is coming or not coming. Our view is that it's coming. It's coming thick and fast. I mean, it might even happen in the next budget speech. We don't know, but our view.
You heard it here first.
Yeah, but our view is that it's coming. I think, and any responsible asset manager, financial advisor should be asking themselves, I think for me, 2 questions with regards to that is, and how it might impact the portfolio. So one is, are we really looking at portfolio turnover as an industry? So portfolio turnover is a first indication of whether there's over trading in your portfolio, which means that portfolio is more likely to get taxed than relative to one with a low portfolio turnover. The other element is within the CIS funds, how much of an individual stock. So portfolio turnover speaks about everything. Individual stocks speaks about how long do you hold that particular stock within your portfolio, and how many times do you turn it. So simple test would be if you held 1 share at the beginning of the year, you've got 1 share at the end of the year, but you traded 20. The problem becomes that 20. That's where the taxman is going to be coming to you in relation to taxing that particular CIS. So a response, like I'm saying, my advice to advisors would be ask your portfolio managers what is the portfolio turnover, and ask them if they are looking at whether or not individual stocks they are actually tracking that kind of activity, and what does it mean for those individual portfolios.
Yeah, it seems like a big one, and I think the industry is going to struggle to come to grips with exactly what it means. With that, I'm going to close off today. Thank you very much for joining us. We really enjoyed having you here. Afterwards, please reach out, chat to us. But thank you very much. Thank you to all the panelists. Thank you for joining us. Bye-bye.